Bloomberg.
Good morning, everybody. What a day to have you here. And after planning this for more than a year, I could not have imagined that these would be the conditions that we are speaking under. As we're speaking here today, the market is pretty jittery. You're looking at an S&P 500, if you've looked at your terminals today, that has wiped out $3.4 trillion in value since the election. It has wiped out all of its gains. Of course, we've met a key tariff deadline this morning, and the market is also pricing in not one, not two, but now 3 rate cuts before the end of the year. So we're in a very fast-changing market, and so we're going to bring you a lot of people who have perspective on just how to look through it, whether things are going to go up or down from here. Now, we've been saying it's a complex time, global economy is rapidly changing, also a lot of questions now about how much capital is needed to fund an artificial intelligence boom. And also, we're going to talk about this a lot through the next 2 days. Investors are looking a lot to private markets for diversification and changing the ways that private markets get to a wide array of investors. Now, we brought together some of the biggest names in wealth, in asset management, deals, and private markets over the next 2 days, and it's the perfect group to set the stage for another pivotal year in markets. Before we get started, I would like to acknowledge our title sponsor, Invesco QQQ, our presenting sponsor, Mass Mutual, and our supporting sponsor, TIAA. Now, we very much encourage you guys to participate, so take out your phones first, put them on silent, and then scan this QR code. This is going to be very handy for everything about this event. On the landing page, you can find the agenda. It will prompt you to download the event app, but there you can subscribe to sessions as well. You'll get push notifications as you need them. You can also take part in digital networking where you can message fellow attendees to set up meetings while you are here. So just type in the special code to access that. You can also find what I think is very important, your Wi-Fi information. There's also a tab where you can click, and this is my favorite part, to submit questions to our speakers on stage. I promise you we will do our best to get to your questions as well. And additionally, if you don't subscribe to Bloomberg News and all of our global coverage, today is your lucky day. On this page, you can click to enjoy discounts to individual subscriptions or group subscriptions and discounts for them as well. If you are enjoying the event, if you have your own thoughts or just want to spread the word across social media, where I'm very active as well, you can follow along with our coverage under the hashtag BloombergInvest. You can add us on your posts as well. You can tag us at Bloomberg Live. Now, let's get started. And before we welcome my first guest, please enjoy this short video showcasing just a little bit about what he's been up to this year.
Clearly, private markets are playing a much more significant role in company growth. Our record performance demonstrates our ability to mobilize across the firm and deliver long-term value.
Please welcome to the stage Harvey M. Schwartz, CEO of Carlyle, for a conversation with Bloomberg's Sonali Basak.
I never had a video before.
Well, glad to make you one. We do a lot of those here at Bloomberg. Welcome.
Sonali, great to be here. Great to see everybody.
So not only are you running one of the most storied private capital firms on the planet, You were also at Goldman, where you navigated very tough moments from the C-suite, including in the wake of the 2008 financial crisis. So you've seen a lot in markets, a lot of ups and downs.
Yeah.
How do you look at the environment that we're in today?
Well, again, it's great to be here. Congratulations on what's going to be an extraordinary event. I think it's my birthday next week. I'll turn 61. I think in my lifetime, the trends geopolitically have been extraordinarily favorable. And I think that certainly some horrific things have happened. But if you think about the Berlin Wall, globalization, and I would say that this is the first time we're really entering a period of what I'll call geopolitical economic tension. And so let's just pause on that for a second. Coming into the election, there was a lot of uncertainty. I mean, it seems like a long time ago now, but if you think back to the fall, there was uncertainty about whether or not we would have an outcome certainty around who the new administration would be. The administration ran on a policy very pro-business, pro-growth, all the factors that support that. And so markets reflected that. And I think there was this huge relief factor in knowing that there was certainty in the administration. It was a sweeping victory, consolidated government, and an ability to execute. Now, tariffs were always in the discussion. What's happened now is, and the markets are obviously reacting to it in a fairly material way, is we're starting to see what is the full policy mandate going to look like. And the reason I started with geopolitical economic uncertainty, and obviously we've had geopolitical uncertainty with the tragic war in the Middle East and the tragic war in Europe, but the geopolitical economic uncertainty, it's a new information set. And the opinions on tariffs vary from they're incredibly inflationary to they are potentially contributing to a recession. And so it's a bit of now uncertainty. And what the election originally people grasped to was certainty. Markets like certainty. And so now we're in a period of uncertainty, and I think you're seeing it in the risk reduction that we've seen over the past several days, and obviously this morning also.
When you look at what's happening with the tariff strategy, I'm guessing this kind of comes into part of that geopolitical uncertainty. At what point are you worried about it crossing over into a tariff war? Is this all kind of par for the course what we're seeing right now, or is there a risk of serious escalation?
Okay, so tariffs are a complicated subject that doesn't really get unpacked very often, so let's just try and do it super fast, given the time constraints. But if you think of tariffs, let's just split the conversation into two things really simply. One would be, let's just say, economic policy and scented tariffs, which can make a lot of sense. We have the lowest tariffs in the world relative to other countries. And then you have tariffs that are motivated by, let's say, political objectives, social objectives. So first of all, you have to unpack the two. This bucket, I think, can be reversed much more quickly. We've seen that in discussions and negotiations. This might be stickier depending on what's happening. But in terms of, and you asked, your language was perfect, Sonali, because the real question is, are they inflationary? And a one-time tariff, let's just say 25% on a country, a one-time tariff is a one-time step up in price acceleration. But it's not sustainably inflationary. Trade wars are sustainably inflationary because then, of course, you could perceive a 25% step, 10, 10, 10. And I think that's what the market is now responding to. But what the market's really responding to is increased uncertainty because we just don't know where the tariff discussions are going to go. It's too early.
To the point you're making on uncertainty and the earliness of the conversation, how do you think about this as it pertains to your business? Do you have to make changes? Are there portfolio companies that are structuring differently? Are there deals that you can't do right now because you don't know what the tariff impact is going to be?
So the vast majority, so for those of you not as explicitly familiar with Carlyle, we're $440 billion of assets. We're one of the largest private capital managers in the world. That's split across real estate, private equity, credit insurance, which is our largest segment, and our solutions, secondaries, and co-invest business. We're micro-investors. So as micro-investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. So we don't, when we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. And so, yes, now in our existing companies, in our existing portfolio, the vast majority are services company. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, we have, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself, but in our portfolio companies, we roll up this data every month. For example, in the PMI yesterday, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
So what are the things that you see now that investors are going to see 4 months later?
So today, nothing about today looks dramatically different than 3 months ago. By that, what do I mean? EBITDA growth is quite solid. Earnings are quite solid. The factors around input pricing, there's still marginal pricing capacity. And demand seems quite high. The consumer seems quite resilient. I think the administration inherited quite a stable economy. You know, inflation obviously not exactly where the Federal Reserve would like it, but it's come down dramatically. And so the environment feels quite good. Now, in terms of what we're seeing in that data, there's nothing suggesting today that the economic underpinnings of that have shifted dramatically at all. What you're starting to see, though, are the things I just described, which is preemptive actions around how best to position, again, around the uncertainty. The way I would describe it is for a long period of time, you know, geopolitical economic risk tails were very tight. They're just fatter today, and we'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean. But this uncertainty factor obviously is affecting markets.
You started to hit on this a few minutes ago about inflation and worries about the impacts that tariffs would have on inflation, one time, more persistent. Where do you see the direction of travel? More recent economic data has created some cause for concern among investors.
Yeah, so first of all, we just came through an unprecedented period. And I got to give, and I know the debate around the Federal Reserve happens a lot. It always surprises me because I think the Federal Reserve and Jay Powell have done an extraordinary job navigating a massive spike in inflation. You know, we went through an unprecedented period of rate hikes. There was a big audience calling for rates back to zero. I have no idea why anybody would want rates back to zero. Rates back to zero is not a normal way to run an economy, and we certainly shouldn't be wishing for that. In terms of getting inflation down, that's a very, very difficult thing to do. And I think the Fed has done an extraordinary job. I think at this point, given we don't exactly know how the tariffs will ultimately settle, I think the inflationary question is a bit uncertain. So what I mean by that is there is a path where you could see a one-time bump in prices, assuming there's no trade war and no future escalation, that will translate through the system as higher prices. It may also cause some demand destruction, which longer term would be deflationary. And you actually could see the economy experiencing stress as it goes through that. So I would say that all the parameters around forecasting inflation, forecasting interest rates, I said, again, I just think we should all buckle up a bit because markets will be more volatile, super data centric, probably too data centric because you can't extrapolate one data point to the future, but it's going to be a sort of a wait and see. I do think the administration will be very sensitive to pro-growth policies, and so I think they'll be watching also.
So with that push-pull going on, what you're looking at is a market that has changed so drastically in terms of rate cut expectations. You had a number of investors feeling like maybe you might get a rate hike this year coming into this year, but market consensus, now you have shifted from maybe 1 rate cut to 3. Market pricing overnight went to 3 rate cuts this year.
Yeah.
Does that make sense to you? So
we were never in the camp. You and I had this discussion 2 years ago. We've never been in the camp that the Federal Reserve was going to cut rates aggressively. Our strategic economist has really nailed this. Jason Thomas, if you don't read his work, you really should. I've worked with some extraordinary people my career, a real privilege, and he's extraordinary. But he has the benefit of rolling up all our data. So he's been saying for a long time rates were stickier. I just spoke to him before I got on the show, and he said, listen, it's more complicated now to have a very firm opinion. Again, period of uncertainty. But it's not surprising to me that the market has shifted to this because of the unknown around tariffs. And I think what the Federal Reserve has proven to us is they're very data-centric because they know they're in a situation that is somewhat novel. So they're going to be very data-centric. They're going to do what they need to do. So if you see inflationary pressure, they're going to moderate up. If you see deflationary pressure or a slowing of the economy, I think the Federal Reserve, one thing they've proven to us now for a very long time, they know how to cut rates, and they're going to cut rates if they need to. But it's not surprising to me that the market is forecasting more of that. But it also, we were sort of shocked when they were forecasting 5-6 cuts, and we were calling for 1 or 2.
So I want to back out for a moment because coming into this year, there was a lot of investors saying America first. And you saw the broader market really reflect that trade. That has changed. You have seen a lot of money flow into international markets. Carlyle is a global investor. Is American exceptionalism at risk?
I wouldn't bet against America. You know, if you go back to the 90s, when in the mid-90s, the European Union and the United States had the same GDP. Here we are 25, 30 years later, we have $10 trillion more of a GDP. There's a lot of fundamental reasons for why that occurred. We don't need to go through them. I think that as a global firm, we see opportunities in lots of places. So we have taken in the past several months 3 companies public. Standard Aero in the United States. We just 2 weeks ago took Hexaware public in India. It's the largest private equity-owned company to ever go public in India. We took a company called Rigaku, which is an X-ray technical company in Japan public. It's the largest ever private-owned equity company in Japan. All of this in the past 6 months. And our portfolios have gone up $5 billion in value, and we've returned a lot of value to clients. I would say that, is it surprising that after the S&P was up 50% plus in 2 years, and the rest of the world had lagged, that there's been more capital moving overseas? No, I do think that if you're going to have a European Union that's going to be very focused on, for example, defense, which is not a surprise to us. We've had an aerospace defense practice for a very long time. On the heels of all the global conflict, defense is going to be a sector that's going to grow secularly again for a very long period of time. Regardless of tariffs, it doesn't matter. And so in a period where you go from geopolitical and globalization to less globalization, you're going to have increased spending on defense. So you're going to see defense stocks go up in the U.S. I think it all seems quite rational to me. But no, I wouldn't bet against America.
So I want to shift gears a bit now because there is this dynamic going on in the markets where you have, of course, the public markets, and then you have the private markets, which, of course, you operate well, and you've kind of operated many times through both throughout your career. So in the mid-1990s, there were more than 7,000 companies. Now there are less than half of that. Many people talk about that being the dynamic of the situation we're in. Nobody talks about what the implications are. If you have such a vast private market, what do you do with that? How do you get more investors access to that?
So you nailed it. I mean, if you went back 20 plus years, there were twice as many public companies. I think there were 8 times as many public companies. If you went back even farther, now there's 2.5 times as many private companies. And the private capital formation has been a trend that has been incredibly persistent for lots of very meaningful reasons. And it's secular, it's not going to change. Any prediction in terms of the sustainability and durability of private capital suggests it's going to keep compounding at 10%. So it'll be a $25, $26 trillion market before we blink in terms of private capital. Now, what's happening is there are a lot of forces in the system that are driving more capital to private markets, demand from insurance clients as they look for private investment grade. And of course, the biggest factor is, and a lot of you are involved in this business, is what's happening in wealth. And really, if you look at whether it's 1, 2, 3% of portfolios in wealth individuals' portfolios today managed by people in this room, then if that grows to 5, 6, 7%, we're talking about an enormous trend. And I think the stats on US pensions, for example, 40% are in alternatives. Ultimately, retirement accounts will be in private capital. It's the perfect balance of liability and return, and it gives investors diversification. So
401ks?
ultimately, yes, for sure. Pace of which, hard to predict. But the wealth transition to private capital, for sure, is a durable transition. Should be. The asset class makes a lot of sense for a lot of people. Advisors, I've spent a lot of time with advisors in the past 2 years. So Carlyle has been in that part of the business for a long time, but it wasn't strategically important as an initiative. When I showed up, we switched all that. We reorganized the team. It's one of our fastest growing areas. But this is, again, we've scratched the surface globally on wealthy individuals participating in these markets. So that capital stream will continue to come in.
How do you think about what might need to change about the industry in order to make this more available to wealth clients as opposed to institutional clients who have been able to get into a private fund, hold it for a very, very long time? Now you have investors borrowing their 401k that might want more liquidity. And do you think that that presents another set of risks too, a mismatch perhaps?
So I think the only thing that gets in the way of the industry and the growth of this is the industry. So if we execute at Carlyle, we don't want to rush. This is all about performance. If we say we're going to do it, we have to do it. And we have to understand the ultimate wealth client who's managed by an advisor or an RIA or one of the big platform partners that we work with. That is our obligation. And as long as we deliver the performance consistently over a period of time, with all the risk factors understood, then we will be successful and the industry will be successful. The only thing that worries me sometimes is there's a bit of an arms race, it seems, to develop solutions. There's clearly competition on the advisor side. Carlyle, I'm super fortunate that I had the opportunity 2 years ago. It's a really iconic name in finance. It's been around for well over 35 years. To be successful in this industry, particularly this segment, you need global brand recognition. Carlyle's well known. We have wealth partnerships in the Middle East, in Korea, in Japan. We tend to think in a very US-centric way that the wealth phenomenon is a US-centric phenomenon. It's a global phenomenon. And that's why I feel confident in saying over the next 5-10 years, you'll see this trajectory of growth. So
we talk about private markets like it's a monolith. But of course, it's private equity and private debt and infrastructure and real estate and all of the above. Private credit in particular has gotten a lot of focus, that $1.6 trillion market of direct lending. It seems that the industry is pushing away from just that into new places. What's the biggest growth area in your mind, and what is driving it? Are there mega forces that will make this industry much bigger?
So there's a flywheel effect in capital formation. This exists in public markets. If we went back many, many years ago, ETFs were new, then they became very efficient tools, then they became some of the most popular tools that exist in the marketplace for investors for a lot of obvious and very rational reasons. It's very hard for finance professionals to create demand for a particular form of capital. I don't think we're actually particularly good at that as an industry. When we really operate well in finance, and having seen it at over 30 plus years, when we really operate well is when we truly understand the client demand for capital. And what is the client demand for capital? The businesses that get supported by this capital are just looking for the most efficient form of capital. So they're not being sold direct lending. They're choosing direct lending over other sources. But what has happened, direct lending in many regards, which has been around for a long time and really grew quite quickly over the past, call it 5 years, what's really happening though is the understanding of the capital choices continues to expand. So direct lending will continue to grow, although more mature today, but now asset-based finance. And there are forces in asset-based finance, private investment grade, returns, and really at the end of the day, what allows us to be most effective at that, Sonali, is we have the right liability structure. So because we have longer liabilities, which our clients provide us, whether they're wealth clients, institutions all around the world, we're able to structure and deploy that capital. But again, it has to be the most efficient marginal capital for the end user. There's no creating something and people come. These are really thoughtful business owners that are choosing to use that capital because it's the most efficient capital. And that's what we have to provide.
Harvey, we are out of time. You spared yourself from my lightning round. So,
really?
What are you doing for dinner for your birthday? You can have that.
I'm hosting the first partner offsite Carlyle's had in a long time. They asked me if I would do it on my birthday, so I said, so all of our partners are going to an offsite for 2 days. I'm super excited about my birthday.
That sounds like
Yeah.
a blast.
Yeah.
Thank
Hey, everybody.
you so very
I hope
much.
you found that helpful. Thanks so much. Have a great conference. Take care, everyone.
Please welcome to the stage Katie Koch, President and CEO of the TCW Group, Jonathan Lewinson, co-founder and managing partner of Diameter Capital Partners, and Mark Lipschultz, co-CEO of Blue Owl Capital, for a conversation with Bloomberg's Danny Berger.
All right, thank you all so much for joining. I'm really excited for this panel. I mean, it's a topic that is very much so in the forefront of a lot of conversations about private debt right now. Convergence, it's been the buzzword of this industry. More capital is being raised on the private side. It's getting more complicated in some instances to draw a line between the two, with trading desks popping up, ETFs for private credit popping up. So we're gonna have a conversation about what exactly this convergence is and what some of the consequences might be. So thank you all, first off, for joining this morning. Really wonderful to see you all. Katie, I want to start with you because TCW obviously has a very robust credit offering, both public and private. To you, what does this convergence mean? Is it actually something that's happening, and what does it look like?
Sure. So first of all, Danny, thank you so much for having us here. And I also really want to say to both John and Mark, it's an honor to be with both of you. Diameter and Blue Owl are incredible firms, so honor to be here. And yes, we manage at TCW, global asset manager. We manage about $200 billion. A lot of it is in credit markets, as you said, private and public, regular way private credit, asset-backed finance, CLOs. And then on the public side, we manage across the full spectrum. So to answer your question succinctly, we do believe that there has already started a convergence, and we will continue to have a convergence in credit markets. I would also make the point that I think we're in the very early innings of this trend. Before I had the privilege to lead TCW, I ran a large public equity business at Goldman Sachs Asset Management. And over 20 years, we saw a very large disintermediation of public equity markets. We now have 50% less public companies than we did 20 years ago. And actually, in that market, it's a binary choice generally on the equity side to be public or private, whereas in credit markets, the same company can actually issue public and private. They can lend against cash flows. They can lend against assets. So you have many more options. And so for us, just to conclude, one of the things that we're always trying to do for our clients is be relevant to the borrower. Because if we can be relevant to the borrower across all of those choices, we have more alpha opportunities to capture on behalf of our clients. So we do see this convergence deepening, and we see allocations going up pretty dramatically, in our view, over the next decade. There'll be some vehicles dedicated to those segments, and there are also going to be some vehicles, both for institutions and wealth, that capture both segments.
So you're talking about some of the borrower driving this. John, I'd love to get your point of view, because you have both public and private credit too, about what is causing a blurring of the lines.
Well, look, I think that borrowers are commercial, and they're reacting to incentives. Historically, where private credit came from was the middle market not being served by the bank syndicated loan market. And so private credit rose up from this idea that middle market companies should have access to loans to be able to do deals, and the success of that built on it and built on it. And I think what you're seeing now is, as private credit succeeded and got into bigger and bigger deals, the line blurs as to what is an obvious private credit deal versus an obvious BSL deal, and it allows, I think, a lot of flexibility for borrowers to figure out what's best for that individual company. And sponsors, company by company, deal by deal, even within the life of the business, the number of times that now the BSL market is taking out the private credit market or vice versa has picked up. And I think that's the idea of providing capital solutions, whether public or private or structured, to borrowers, oftentimes private equity and otherwise, has allowed the entire industry to take off.
Can I press you a bit on that, though? Because you're talking about offering different products to an issuer. What does it look like when it's one and the same when it's hard to distinguish? What does that actually look like?
Well, there's both technical and theoretical differences, I would say, or normative differences. So when you think about a private credit loan, oftentimes there is higher interest rate on it. Sometimes actually the covenants, most of the time the covenants oftentimes are better. But you're dealing with a smaller group of lenders. You're dealing with, I think most importantly, and this maybe hits the convergence question head on, you're dealing with a different set of norms. And so in the public markets, you are oftentimes dealing with underwriting banks who are then going to syndicate it to many, many, many firms. And you don't really control who owns it. And so your capital structure will look like it will. And so if your debt trades down, it might be hard for you to do M&A because you can't issue debt at par to kind of buy a business that was important to your thesis. But in private credit, if you think of really what the definition of private credit is from a norm perspective, it's that not too many people are in the loan, that you know who is in it, and then most importantly, if something goes wrong, your lenders are going to think about it as a relationship, as a repeat player, and they are going to work with the sponsor in a conciliatory way to deal with the business. And so while on paper it says, oh, I have a floating rate loan, who cares if it comes from Blue Owl or it came from a Goldman Sachs syndicated deal, the norms are actually not convergent. And in fact, they're very, very different in the markets, and it allows the private equity sponsors to choose what's best for each business.
So I definitely want to come back to this point because I think it's a really important one. But Mark, I want to bring you into the conversation because your DNA is private credit. And I wonder is what you see as the driving force for this. What is the incentive to have a convergence, a blurring of the line of public and private credit?
So I think it's probably worth trying to unpack even what we mean by the word convergence, in so much as I really loved what Katie and John just had to say, and I think it was all spot on. And here's the question: is convergence about this sort of bringing together of a very vibrant public and private market? And to John's point, for example, people are looking at both solutions, and maybe even in some cap structures, there are both. There's public and private pieces. That version of convergence, to me, makes a tremendous amount of sense, and that absolutely is happening. And I think that does favor the organizations like ones here represented, where you can offer a full range of selections between different types of solutions. However, convergence, I think, also is being used by some people to talk about sort of turning private markets into public markets, or I don't know if the reverse even makes sense, public markets into private markets. And I'm less clear on what that, honestly, I'm really less clear on what that means or what problem we're trying to solve. I would say from a private market practitioner, we manage about $250 billion all focused on the private markets. I don't desire to sort of turn those into public securities. That solution already exists. In fact, we rose, as did many other private providers, private credit or otherwise, to provide a longer-term pool of capital that isn't subject to the vagaries of the daily market. And today is a perfect example. If you're a borrower with us, then today you still have steady access to capital. We're not daunted by today's volatility. We're looking forward. But if you're a public borrower, you don't have access today. That's it. 2 days ago you thought you did, and today you probably don't. To me, that is, I don't think, a problem, quote unquote, we want to solve. In fact, we might be creating a problem if we just take the private market and just introduce all that volatility.
Katie, I mean, I want to bring you in this because if we are entering a more volatile period, what does the macro setup look like for a world where private credit looks a little bit more public, where private credit might be subject to some of the volatility of this market?
I do think we have an interesting macro setup, so I'll comment on that for a second. So, we believe in the business cycle. That doesn't sound like a really brave statement, but we haven't had one for 17 years. That's something for all of you to think about when allocating capital. Everybody up on this stage has been whacked in the face by a business cycle, I think, right? Is that okay? Good. But many people in the industry haven't. I think that's a real thing. We had a short one, but we gave out a lot of free money and we fixed it quickly. So I do think that we are believers in that. We see some softening data. I don't need to rehash it. We all watch Bloomberg and we know what that is.
I hope so.
But I would say that the valuations haven't yet adjusted for that macro. I believe that to be true in private markets. And here I'm just talking regular way private credit, corporate lending. I believe it also in public markets. And so how do we navigate? So let me just say one thing on why I think it's what we're watching, and then I'll end with a comment on how we're positioned against that. Just stick on America for a second. we can't really get to a true business cycle until the consumer rolls over because it's 70% of GDP. The consumer's already in a recession and has been for a while on the very low end of the market, just not the high end of the market. And I think as many people here know, 50% of consumption in the US is driven by the top 10% of the consumer. So you need to see a crack there to really get the business cycle moving. Employment will be part of that. We have payroll numbers on Friday. We know that there's some weakness in the employment market. It's not very weak yet, but we are seeing layoffs across multiple sectors. So we'll watch that. That's something to watch. I'd also watch equity markets because this top 10% of the consumer, a lot of their wealth is in houses and in equity markets, and they're transferring that wealth, the baby boomers, to the next generation. So I want to posit to all of you that the transmission mechanism may be a little bit different this time around and come a lot through equity markets. So that's something to watch. I want to end by saying, how are we positioned in this environment? In liquid portfolios, we're running a very large underweight to credit because against this possibility of a business cycle and some softening, I don't want to over dramatize it, macro data, we have credit spreads still at record tights versus the last 20 years. And in the private markets, we're deploying capital probably more slowly than our peers. We have strong covenants. We are very disciplined lenders. We say no a lot, and we are at slower rates of deployment than the industry at large. I'll end by saying where we interestingly do see some opportunity, even in the absence of the business cycle kicking in or a recession, is in rescue finance. So that is where we are deploying record amounts of capital. And that is because interest rates have stayed high because of inflationary pressures. You've got a lot of companies with upside down capital structures. The operating business is okay. The balance sheet is not. And there's an opportunity to go in there, restructure, and ultimately deliver equity-like returns for our clients through the credit.
Honestly, just putting your thoughts and Mark's thoughts together, John, what I kind of almost hear is that this is maybe a horrible time to be an investor if you are seeing a convergence of public and private. If you thought you were getting an illiquidity premium from private markets and things are popping up like trading desks to trade them, or maybe you have to mark to market more, ETFs are coming up, it seems like maybe if you're an investor, if you're an LP, you'd want a clear difference between the two. I mean, is there not some degree where the macro environment that Katie was describing might undo some of this so-called convergence that's happening?
Sure. I think, look, Katie pointed it out well, right? We've seen, more people have seen Bigfoot in the last, decade and a half than a business cycle, most likely. And that means all of us are to some degree asleep. And if you think about the way private markets operate, they don't get marked routinely. And so you could sit around in a private portfolio for a long period of time and think there's no trouble under the surface whatsoever and have really no incentive to kind of dig for that trouble under the surface. And so one way to maybe think about the convergence is using not merging public and private markets, because as Mark said, there's reasons for it and against it. But what you might want to think about is what's going on, what are the public markets telling you that help you underwrite in the private markets, right? So Katie was talking about, hey, spreads are really tight. That might tell me that the market is a little complacent. There's not a lot to earn there. Let me find elsewhere. What I see is there are sectors in the public market where there's a look ahead, where it's saying, hey, maybe the future is not as good as the immediate past. If you think about the way AI is interrupting progress in places or disrupting things, let's look at the software space. A lot of private credit has been in software, partially because software is not cyclical. And private credit was a business that pitched itself saying, hey, we're not going to be in the most cyclical places. But if you look to the public markets, the BSL market, many of the security type of software names have had trouble. Some of those moats were disrupted. Those BSL loans trade down. That, therefore, all of a sudden informs immediately, and in our business, we have public and private in separate funds for separate LPs, but kind of sitting together as a team, saying, wow, that would really change our underwriting of all of maybe SaaS software, or all or partial of it. And so I think that's the best way to think about it. Allow the markets to inform each other, such that you're not just, say, in private credit, not aware of what's going on in the markets, and in public credit, kind of having the back and forth.
So it's almost more like they're talking to each other than becoming one, almost.
In our business, that's what's happening. They're not
Right.
one. But sometimes private credit refinances, sometimes the BSL refinances, but you always have to think about, hey, what's going on in public market spreads? Why is that not being reflected in the fact that I'm being asked to do a very, very tight deal in the private markets, and vice versa?
Just adding on that, if we think about the public and private market and this sort of adjacency, our job collectively is to gather all the information and knowledge we can, right? We've looked at 10,000 companies to make the loans that we have. And so there's information value in, just as John said, and as Katie said, in looking at the public markets, looking at the private markets, looking at industries. But I think for me, I come back to this point about the private market's job is to be able to take, and the opportunity, the reason we can earn a premium return for the risk collectively, is to be able to sort of see the signal for the noise, which is to say, today, everything is red. Does that make every company so much worse today than it was yesterday? No, certainly not. Now, you have to pick through it all and figure out what the implications are. But the difference is the sort of, call it almost technical or funds flow nature of movements like today. That's not what our investors want us to respond to. They do want us to respond to fundamental shifts in the world. So when the meta trend, and it's undeniably correct, right, that AI will have dramatic effects in the economy, then they want us to help guide their capital into things like hyperscale data centers. We want to skate to where the puck is going. So I think, to me, it is about looking at the markets holistically. And look, a great economy, the US economy, is one that has really vibrant public and private markets.
So if the convergence happens more forcefully, Mark, is it an unhealthy thing then? If you are forced as a private credit manager to market more frequently because the underlying asset starts to trade more frequently, and you have to incorporate some of the volatility of the market, is that an unhealthy thing?
We mark all the time. I don't find the marking to be the question. To me, the challenge and the negative of the public market in certain circumstances is accessibility. So it has to do with, is it even available? Think about this, go through COVID or hyperinflationary times or the run of Silicon Valley Bank. It really didn't matter what the particulars of a company were. If you were in the public market, you had no access to incremental capital. If you were in the private market and you still had a fundamentally sound business, you had access from us or others like us. So to me, I look at more the volatility introducing issues of access. We mark all the time. We have BDCs, right? They trade every day. So people know more about the loans that we own than they could possibly know about the loans on a bank balance sheet, for example. Every single loan, you can go through our line items. We rate every single one every single quarter. So it's a bit of an illusion, this idea that there's not transparency in our marketplace, but it is true that we're making decisions that are looking not today, tomorrow, but through to the future.
One fun element of it is there's been nothing more boring in maybe the history of conferences than going to a private credit panel for most of the last decade.
I don't know, they're like hiring celebrities to show up.
Well, that's what I like them. No, partially because everyone's business is similar, right? Mark, like talking about like mega cycles, right? The mega cycle has been the rise of private credit and kind of flanked by firms that have kind of really taken advantage of that. And the reason that the conferences are not as interesting as public market conferences is that, you can have a guy in a public market, I'm long Coke, I'm short Coke, I like Pepsi, right? A total back and forth. Whereas in private credit, it's been a growth of a market that was very, very small, that didn't really exist, and now really maturing and coming into flying with similar business models. And maybe what convergence now can mean is they're going to look a little different. Right? The way we do, so we have a BDC, we have a CLO, we have public and private, but we do it a little differently than they do it at larger firms to my right and my left. And that how those portfolios, how they're going to, all of a sudden, we might sit here in 2 years and it might be a little more interesting on these stages because people's business models, their approach to how often they're trading, their approach to trading, their approach to these norms, how are these norms going to trade are going to be different. And again, at least it'll sell tickets to Bloomberg Invest.
Hey, well, that's we're not here to do that. Then I don't know what we're here for.
It's funny too because everyone's looking for the drama in private markets. Everyone's looking for the drama in private credit, and I don't know if you want to call this good or bad news. It's good news if you're an investor. It might be bad news for the question of seeking drama, which is the private markets by their design have lower amplitude. We and the norms that John talked about. We work with our partner companies to solve problems. It's not, I win, you lose. People are looking for that shoe drop, the big dramatic moment. And I think people are going to be waiting a while to find that moment because it's not the way we operate.
Kate, can I bring you in on this as well? Because also Mark is talking about a bit of a difference of an incentive structure, I think we could call it that. That in private markets, you have an incentive to work with the sponsor, to work with the borrower. Public, not as much. You want to get into the right asset at the right time. if there is a convergence, what happens to that incentive structure? Does something merge with that too, or are we talking about two different lines of how companies and how issuers and how borrowers work together?
Yeah, and I think that the way that people approach this is going to be, if we do get a business cycle and we do get more differentiation, to your point, not only has the asset class kind of gone up and to the right in terms of growth and launches, we actually haven't had that much differentiation of the credits in most of the environment in which private credit has existed. We have an asset class in private credit that 95% of people haven't invested through a recession, a cycle, or when rates were persistently not zero. So I would just start by saying I don't think we know yet, and we're going to find out. There was a question from the audience here that came up just around, like, where will you see signs of excess? Yeah. Like, if we are having a business cycle, where are those signs going to get expressed? I think it's going to be different this time because we know that part of the high yield market, which usually we can look to for early signs of stress, has migrated towards private credit, which means that there's going to be possibly some more opacity or delay in those signals. I don't think there's going to be a crisis because I know you've originated well, you've underwritten well, you have all your covenant, you're going to do the right thing for your clients, but there'll just be a little bit of delay in how that signal comes through. And I just want to end by saying you're right that there's more ways and in theory, more tools to work out of a private credit that's gone wrong. I would just say to everybody in this room, defaults haven't yet risen. And that is, someone asked the question, where do you look for excess? Generally, you would look for defaults. We haven't had a dramatic rise in defaults, in private credit. There's been defaults in the bank loan market, but in private credit. That doesn't mean there's not stress. It actually may mean that a lot of those people wrote without covenants. They can't come to the table to restructure, and there's amend and pretend. So if someone said, where should we look? Look at extensions. Look at how many amendments are happening to those loans. That is a precursor sign to stress. And I don't think it's a crisis for the whole asset class. I'm a big believer in it. It's going to grow. The demand is there. The supply will continue to be there. It's going to be a great place to be. But there is going to be some testing around this. There are going to be some things that go wrong. And I think looking at people who have given up covenants, who have made optimistic loans, which isn't a great way to make loans, we're going to see some of that come through in this cycle. And that is my answer to where the stress will be. It's not going to express itself the same way it has previously.
Is it worrying then that people are buying private credit ETFs right now, that you have retail investors who maybe don't know the asset class as well in a vehicle that's liquid with underlyings that are less liquid?
Well, there's only one person that's done that, so I'm not going to comment on that.
Fair enough.
But I do want to say that going back to, because we're throwing around this term private credit, I want to say that some of these vehicles being offered to individual investors are IG. They're very different than the high yield market, the traditional middle market lending market. And so I want to make that point. And then there's final comment, because we haven't talked a lot about origination here. I do think that we've talked a lot about having good covenants, helping you work through a difficult environment. But the story does start with origination. And I think going forward, there's going to be much more scrutiny on behalf of LPs for what are the origination advantages here going forward, and who are you working with on that?
So yeah, the irony is that if you go back to before the financial crisis, there was a convergence in that a lot of people were doing private credit out of hedge funds. And structures that absolutely couldn't. You'd have monthly or quarterly liquidity hedge funds that were making illiquid loans. And that turned into a total disaster, and it exacerbated some of the problems around the financial crisis and liquidity constraints. Today, even in vehicles that may be shown to have done very poor underwriting, the liability structures are pretty good in terms of the ability of people to hold on to the capital, to see the deals through, and the run on the bank element. You saw some of this in the real estate market when some of the kind of retail products for real estate put down gates that were designed to allow people to stay in and work these things through. And so what was one pool of capital doing things has actually come apart. And the question is, how will it come together again? And if you think about excess, to Katie's point, is a cycle will show that not everyone can have the same underwriting standards. So some people will have been bad at underwriting and their portfolios will be bad. But it could also just come from an industry microcycle. If we do still never get to see the Loch Ness Monster and never get our time in the sun for a cycle, it could be that industries. So whether we've seen the microcycles in retail and in energy and in part of healthcare and in banks and in telecom, what's the concentration of risk in private credit vehicles? Do they have 30% in an industry? If that industry is particularly hit, what does that mean? Do they then all of a sudden say, wow, we can't necessarily exit those because it's private? How do we find capital? Do we lose lines from banks? And so I think building on Katie's point, there's definitely excess. It's not obvious where it is, and you don't need a cycle to show it. You might just need industry microcycles to kind of show in particular instances.
I mean, remember, in credit, you either get 100 cents back or something less.
Yeah.
That's it.
Yeah.
Those are the outcomes. And so it all gets down to origination, underwriting, documentation, and these are the calling cards of a well-run private credit business. Some are well-run, some we're going to find out are less well-run.
No one here.
Certainly not here. Not if they're smart enough to be at Bloomberg.
Yeah, of course. I have a feeling we could probably talk about this for the rest of the conference, but they might never allow me to come back to moderate. So unfortunately, we're going to have to end it there. Thank you all so much. Everyone, please join me in thanking Katie, Mark, and John.
Thank you.
Thank you so much. Hi, guys.
It is clear that we're at the beginning of a mega cycle in spending in AI. Be patient and let the opportunity set come to you. Every now and then you're going to have a view that's contrary. Those are the views you will make the most money on.
Please welcome to the stage Dawn Fitzpatrick, CEO and Chief Investment Officer of Soros Fund Management, for a conversation with Bloomberg's Eric Schatzker.
Good morning, everybody. Dawn, did you ever imagine that we'd be here 6 weeks into the Trump 2.0 era and the Dow is flirting with negative, the S&P 500 is down 2.5%, the NASDAQ is down 6+? Did you?
So I would have thought that the markets would have held up better, but I would also not have thought that we would have had the level of frenetic activity out of Washington. And when we look at the headlines over the past 24 hours, they've been kind of breathtaking in speed and scale.
I'd like to point out, because some of you here may not know, or perhaps you've forgotten, that the Treasury Secretary, Scott Bessent, once had Dawn's job as Chief Investment Officer. He worked at Soros in the 1990s under George, of course, and also under Stan Druckenmiller, and he returned as the CIO in 2011. You arrived in 2017, a couple of years after he left, right?
I arrived about a year after he left.
I bring this up not just to establish a distinguished lineage, but because it serves as a useful reminder that Scott Bessent has to be, right, the most market literate and market savvy Treasury Secretary since at least Bob Rubin, and perhaps in American history. Now we have a president whom we know thinks of the stock market as a daily report card, and a Treasury Secretary who's laser focused on macro indicators. Why is that important?
So a couple things. Scott is incredibly smart. He's capable, and I think he is the most market savvy Treasury Secretary we've ever had. I think it matters because when he says something, you should take him literally. So he has said he and Trump care about the level of 10-year treasuries, and I think he will pay very close attention. In a kind of perverse way, right after the election, we had the Trump bump, and as Eric pointed out, we've had something different in the past week or so, and you've seen that 10-year treasury go from 480 in the middle of January, where they were getting nervous, and if you remember, they kind of backed off some of the tariff timing at that moment in time. Now you have a 10-year treasury that's down at the 412 level, and I think they should be getting a little nervous. I think the one thing that market participants maybe have underestimated. In the first term, we all said Trump is very SPX sensitive, and that was invariably the truth. I think with Scott, I think their pain tolerance is different, and I think they're more sensitive to a broader set of asset classes, and I think they might believe that ultimately they have more levers to pull when and where they need it. That said, when you think about tariffs, we can all look at a textbook and we can say, and I think the Treasury Secretary said it today, manufacturers will absorb the price pressure, and then you can also argue that it's a one-time price shift. But I think what you can't control is consumer confidence and corporate confidence, and I think that is what is falling off a cliff right now.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
So I would take the other side of that bet because, again, I think ultimately they will bear more pain than I think market participants originally thought, but there will be a limit. And I think they will make deals.
There's a view in the market that Scott's preoccupation with keeping the 10-year yield low foreshadows a coming change in bank regulation. You know, if the administration wants to juice demand for treasuries, it could exempt treasuries from the supplementary leverage ratio, one of the capital penalties that the big U.S. banks have to pay. Do you think they'll go there?
So I definitively think that is going to happen. So when you look at kind of the net issuance of treasuries post-COVID, it's almost all been bought by the levered hedge fund community. And I don't think, first of all, that's not a sustainable kind of marginal buyer. And it also probably isn't good for market structure and market stability. And when you look at what came out of Congress last week, you know, the deficit is not going lower in any material way. So what I think they're going to do is they will change bank regulation and the supplemental leverage ratio, allowing banks to buy treasuries in ways that won't be regulatorily punitive. And the next step is they will try to take some leverage out of kind of that basis trade in the levered market. And again, I think this is where Scott understands the moving parts in ways that I think will ultimately be really helpful.
You've given us a couple of clues about how you might be trading the bond market. You take the other side of 3 rate cuts this year, but at the same time, you think that the administration will be inclined to help lift demand for treasuries. How are you trading treasuries? Like, what would you buy and where? And are you a holder or are you a seller at any point?
So we are a reasonably large holder of U.S. government bonds, but we're below our benchmark weight by a little bit. And what we've been doing is we've been using volatility as our friend. So in January, when the 10-year rate spiked, we were buyers of bonds at that time. And then now, as you've seen kind of rates go lower, bonds rally a lot, we're not taking profits. And you'll see us continue to build a position into that volatility. And I think you're going to see continued volatility. Again, this moment in time, rates are going lower, but I don't think that's going to be true for the next 4 years.
Volatility can be your friend. Is that? I guess I better put it this way. What's the best thing and what's the worst thing about trying to put money to work in this market?
Yeah, so we're technically an endowment, but we use the best of the endowment model and the hedge fund model, so we can react very quickly. And I think we're very good, I would argue probably one of the best in the world at connecting the dots across asset classes. And from our perspective right now, the volatility is great. I think market structure is still challenged in that liquidity at moments in time when there's a lot of volatility is challenging. So you can see a great trade, but sometimes buying as much of it as you want is easier said than done.
Do you have a favorite trade right now?
Yeah, that's a good question. So we are tactically, at the end of last year, we bought call spreads on Hong Kong equity indexes. And I continue to like that trade, so we're holding that position. And again, when you see kind of the micro and macroeconomic data coming out of the US and you see the data in China, I think you will see a tactical deal out of economic necessity between China and the US. And I think when you look at investors generally, they've left China for dead. So I think there's going to be money forced into that market. Again, for us, that's more of a short-term tactical trade than a longer-term position.
I feel like I have to ask you the requisite Mag 7 question. Those stocks are down about 13% or so from the peak in December. That was, as of yesterday, I didn't check this morning, probably down by more. Tesla's off, what, 40? NVIDIA's lost 24%. Are those buying opportunities?
Yeah, so I think the Mag 7 are, I mean, those are extraordinary companies with real earnings power, and the unwind here has been pretty violent. So I would take the other side of that trade.
And of course, we are witnessing some historic shifts in U.S. foreign policy. It would appear that the United States is to a degree abandoning Europe, perhaps embracing Russia and Vladimir Putin. Has that translated? Will it translate into great macro trades?
Yeah, so, Russia's not that relevant from a trading perspective. When they invaded Ukraine, it didn't really reverberate through markets. And I think in the context of what's going on now, the only thing that's worth watching, in my opinion, in the context of trading markets, is oil. And whether ultimately, and this is a big if Trump can negotiate a peace between Russia and Ukraine, whether part of that deal is, Trump needs more oil, right? Part of what he's been promising the US consumer is lower prices, and particularly lower prices when it comes to the gas pump. The US really can't drill more. It's not in Saudi Arabia's best interest to produce a lot more. They need about $90 a barrel to balance their budget. So the lever he can really pull there is Russia. And one kind of wild card would be Russia dropping out of OPEC. And that would have a real impact on oil price in the context of moving it lower.
What about America ripping the security blanket away from Europe? I could imagine that we've already seen, right, the Germans move toward spending. In fact, I think they found some flexibility this morning, right? 200 billion euros on additional 200 billion on defense. And we hear the same noises out of France. Surely that has to, result in at least some bond issuance.
Yeah. So if you look at Europe, and if they end up spending the 2.5%, to 3% of GDP on defense, that's $175 billion a year. And when you think about the fiscal space they need just generally, the amount of bond issuance out of the EU and European sovereigns is going very materially higher at the same time when US net issuance is also going higher. So I think one of the things that we might see, and this isn't going to happen tomorrow, but I think it could happen in the next 12 to 24 months, is a failed auction out of Europe. I just think at some point, sourcing that marginal buyer is going to become extremely difficult.
Do you feel confident enough to predict which country will fail to sell enough bonds?
The two most vulnerable countries are the UK and France, in my opinion.
Dawn, there's a lot of Western money, including some of yours, trapped in bets on Chinese private companies. ByteDance, of course, tops the list, but there are lots of others. Could that logjam maybe start to break if Presidents Trump and Xi negotiate some kind of a deal, whether it concerns trade or whether it goes even beyond trade?
So I think there's a lot of people hoping for that, and as Eric said, us included, where we have private capital in China, and we've been, everyone thought these companies would come public years ago, and the markets just didn't allow for that. And if you remember, the Chinese government kind of closed that door at the 18th hour. So if there is a tactical deal between the US and China, I think there's a lot of market participants, us included, that will hope that the private to public markets unfreeze and we can get some money out. I think if you get money out of privates, it's only going to be in that very, very tight top tier, like a ByteDance. And to be clear, ByteDance is probably the most largely held private company by real asset investors in the world. So there's a lot of people with that hope trade on.
This feels like a good time for us to wade into the public-private debate for a moment. Because for years, right, foundations like yours and endowments and pension funds and sovereigns have been plowing money into private equity. Of course, they've had some trouble getting that money out of private equity over the past couple of years. And now private credit is the rage. And more capital, as a result, is flowing into illiquid vehicles. Why do you believe in liquidity when everyone else, right, from Apollo to BlackRock, is extolling the virtues and the benefits of private markets?
Yeah, so over the last, again, we typically are benchmarked against the typical largest US endowments, but over the last 6 years, we actually let our private equity positions roll off. We still allocated to the best managers, but with a really high bar. So we lost about 1,000 basis points of exposure there, which, to be clear, has served us really well. And at the same time, we pivoted to public markets. And it's interesting. I think a lot of both high net worth and institutional investors pivoted to private markets in part because you didn't get a scorecard every day. And your Sharpe ratio and the returns looked artificially good. And by doing that, first of all, I think those investors are in a world of hurt right now, both in context of liquidity and in the context of they've massively lagged a equity market that has until the last couple of weeks been on fire. But the other thing is, if you're Soros Fund Management and you have a long-term perspective in public markets, you have a lot less competition because it's most of the active money is large multi-strat investors. So for us, the capital allocated to public markets above our benchmark, we've annualized 650 basis points of excess return over the last 5 years. And I think it's because we play our own game.
What does that mean in actual numbers? 650 over what last year? 650 over what in 2023?
So it's always our beta benchmark is MSCI ACWI, and then we have the risk-free rate. So we don't give ourselves any credit for what you can get, by in money markets or what you can get by buying beta, and we assume we're at our benchmark weight in those. So add those together and then add 650 basis points. By the way, the thing that's pretty interesting is when you look at the last 2 years, your private equity has lagged by more than that. So you needed that active return in public markets to make up for the sins in private equity. But we think our peer endowments and foundations haven't had that offset.
So you're thinking more along the lines of a hedge fund. Tell us what you returned in 24, what are you year to date, and when you look at those numbers, do you think of your competition as Citadel, or do you think of your competition as the Ford Foundation?
So we think of both. Like, we want to be clear, we want to take the best from both of those operators, but we don't play Citadel's game. There is no one. Citadel plays the multi-strat game, and nobody plays it better than them. And I think the distance between Citadel and their competition has only grown. And again, relative to other foundations and endowments, there are some things they do really well, and we like to take those pieces. But again, play our own game and play a game that we think no one else in the world can do quite the way we do it.
Dawn, on behalf of everyone here, thank you very much for joining us here at Bloomberg Invest.
Thank you.
Please welcome to the stage Jonathan Gray, President and Chief Operating Officer of Blackstone, for a conversation with Bloomberg's Sonali Basak.
Build with Blackstone, invest in our funds, not just in fixed income. I really think you're missing out on an alternatives industry, 40-year legacy.
I didn't choose the song, but I wish I did.
I love the song. Love the song. It's from our holiday video at the end of the year, if you haven't watched yet.
I was going to tell you to show up in the cowboy hat, but anyways, thank you all again for being here. John, thank you for being here. Tariffs. I mean, I don't know how you start anywhere else on a day like today, because the big question is, when you own so many businesses, when you have so many types of debt and equity tied to companies around the world, how do you think about the way this is evolving?
So I'd start with us. The good news is we don't own a lot of businesses that export physical goods into the United States at scale. So that's helpful for us. But of course, as you point out, we're big investors and lenders to lots of companies, and markets impact us. And what I'd say is we try to take a little bit of a longer term perspective, that there is tariff diplomacy going on, and that what is happening now could change depending on what market participants, what government officials do. And you've got to take that longer term approach and hope, or maybe expect at some point, that they'll get to outcomes, markets will calm, and actually in a moment like this, you look around and say, are there good businesses that are now on sale? We can deploy capital into this volatility. So I would just say to investors, be a little bit patient here. Let this tariff diplomacy play out a bit.
So as you look across the universe and try to find things on sale, what are you finding?
Well, I don't know if, it's so short term right now what's happened, but in terms of the areas we find most interesting, we love to be thematic in what we do. Think about sectors where there are long-term tailwinds that are quite compelling. So digital infrastructure has been a huge theme for us. Data centers, we've been the leading investor in the world in that area. There's obviously been concern given DeepSeek, but we continue to see big demand throughout that whole sort of value chain. We love power and energy. We think we're moving to a world of very heavy electrification. It's because of data centers, reindustrialization, robotics ultimately. We invest in generation, transmission, utility services. We like franchise businesses that are capital light. We bought in the last year Jersey Mike's. We bought Tropical Smoothie. We bought a small coffee chain called Seven Brew. We love the alternative space, stakes in other managers, secondaries, lending to private equity firms. And geographically, I would say also India is a really interesting place for us where we've leaned in, where we think there's a long runway. The last one I just throw out is a cyclical recovery in commercial real estate, which we're big believers in and have been deploying capital.
So big picture as well, people are talking about a return of the deal environment. People are talking about the return of an IPO environment. In the IPO space in particular, it's been almost stunning how slow it's been this year. Isn't it a big problem if this doesn't come back sometime soon? There are a lot of companies out there that have been holding assets for a long time.
Yeah, the IPO market and the M&A market, as you know, Sonali, are pretty cyclical. And we've been through a rough period of time, right? We saw the cost of capital go up globally as rates went up a bunch, as central banks tightened to fight inflation. We saw spreads go up a bunch. Market participants became cautious. We had a regulatory environment that was not that friendly towards M&A activity, particularly from strategics. And I think we're beginning to see a lot of that change. We've seen credit spreads tighten a bunch, both investment grade and not investment grade. The stock market, even with this recent trade-off, I think is up about 50% from 2 years ago levels. I think there's a pent-up desire to do transactions. And IPOs, when you have a stock market trading well, it's like a magnet. It starts to pull companies in as well. We've got a number of businesses that we're looking to take public this year. I think there's a receptivity to IPOs. But volatility, like this week, can slow things in the near term. But if you said, look, 24 was an increase both in IPOs and M&A over 23, I think you'll see the same thing in 25. And there's sort of a mean reversion in terms of activity levels, IPOs or M&A as a percent of the public market's value. And we're below that. And there's just a lot of pent-up demand looking for liquidity. I think it will come. I think high-quality businesses want to be owned in the public markets. And this week, it may not feel as good, but I think when we finish the year, it'll be a better year in terms of activity.
The end of the year's a long way away still, John.
I was just saying cumulatively, but yes.
But to that end, if we think about what happened this week, if you looked behind the green room, a lot of people one by one are looking at their phones, looking at the stock prices of their own firms and others, and it's been pretty ugly. Yesterday was the worst day for the S&P this year. We've erased everything that we've seen the market gain since the election. Do you think that risk appetite could be significantly stunted in the near term?
In the near term, certainly. When you have these moments, investors tend to step back. Market participants say, well, do we want to make that big commitment today? Is the world more uncertain? But we've seen these, periods of time. And again, I like to look at the bigger picture. And what we see out there is still a decent economy. Right? In the fourth quarter, our private equity companies grew 7% in terms of revenues. We still have very low default rates amongst our private equity firms that we lend to today, non-investment grade lending. Our CEOs, when we asked them at the end of the year, do they see a recession? 0% in the US said yes over the next 12 months. And we see inflation continuing to moderate. So shelter costs, the biggest component of CPI, is running well below the government's 4.5% data, which tends to lag. Input costs are still pretty flat. And when we look at our companies and ask them, is it hard to hire? They say it's the easiest it's been in a few years. And so that combination of a healthy economy, some weakness certainly on the consumer side, but overall pretty good in the US, and inflation that is moderating. Maybe the pace of disinflation isn't as fast as it was a year ago. That should give the Fed some room to bring rates down. They'll do it very gradually. That's a pretty good backdrop. So that gives me more confidence, again, why I think we'll see this pickup in activity.
There might be a silver lining, to your point, on the Fed potentially cutting interest rates gradually. Every morning, the first thing I do is look at the 10-year yield. We are down to 4.1%. Which feels pretty stunning given we were flirting with 5% not too long ago, or 5% was the dangerous level that investors were talking about in January, potentially hitting. You're a big investor in real estate. What does that mean for the pressure that might be eased across the real estate industry, particularly the hardest hit parts?
Well, I'd start with sort of the bigger picture on real estate, which is we've been through a tough period of time, right? The sharp upward movement in rates hit real estate values, hit multiples, cap rates went up in real estate, spreads, borrowing costs went up a bunch. And in the office sector in particular, because of remote work, we saw a sharp decline in demand. And so that created a very tough period for valuations. I think we're on the other side of that. You and I have talked about that over time. And, the question is, should I be an investor in real estate? And what I'd say is, whenever you have a sharp decline in value and then people stop building new real estate, we've seen 2/3 decline in apartment building and warehouse building, then it's generally a good time to invest. And the real question is the pace of the recovery in value. If it comes purely from cash flow growth, it may take a little more time. If rates fall as they have, then you may see an acceleration in multiples and it'll happen more quickly. But the path of travel in real estate is upward. So we've been leaning in quite a bit. We privatized a number of large companies last year. Clearly, real estate is a sector that's going to benefit from a lower cost of capital. But even if it goes back up the 10-year, I still think the path is very positive, just given the lack of new building in the space, which creates the ground really to have positive cash flow growth going forward.
I'm going to give you what I think might be a tough question for you. In the world of real estate, which is your favorite child, data centers or offices at the moment, in terms of the near-term ability to put money to work?
It's an interesting question. I think from a value standpoint today, offices are pretty compelling in a place like New York City or San Francisco. Because in New York, you have financial services firms who are growing rapidly. You don't have any new building. In San Francisco, the values fell very hard, in some cases 75%. And AI and technology innovation really housed in San Francisco. And so I think in some of these markets now, given the sharp decline in value and the lack of new supply, office buildings become interesting. You definitely want to buy more modern buildings. But I still like the data centers too. There, what's attractive is this need for compute power. I referenced DeepSeek, but obviously the cost of compute has come down pretty dramatically. And we think the usage is going to go up. There may need to be a little less training, and it may be more inference, but our lives are migrating online, and I think these data centers are a critical part of that infrastructure. So I'd say I like both of these children.
So on data centers in particular, the estimates are staggering. But they're not only staggering, they're all over the place. You've seen estimates from a need for $1 trillion or $3 trillion globally to build data centers. You've seen estimates higher than $10 trillion. Both things can't be true.
Yeah. Well, I think it's a question of what you're measuring. If it's just the physical data centers, it's probably on the lower end. But if you're talking about the GPUs that go in those data centers or the power that needs to go, then those numbers get really large, and then I'd be at the higher end. And it's a global phenomenon. I mean, if you think about where the world's going, I think our lives are going to be so impacted by this technology. What we do, how companies function, coding, customer engagement, even things like translation today now. You don't even need translation anymore because the machines can do it real time. I think margins in companies are going to expand dramatically. I think we're going to use these bots to help us do so many things in our lives. And so ultimately, I think the infrastructure spend against this will be quite significant. I'm not astute enough or knowledgeable enough to know exactly what the number is, but it feels like it's going to be very big.
You know, one investor that we're speaking to tomorrow has this theory where AI is going to be so productive that they're betting on leisure and entertainment because they believe the work week is going to be shorter. Do you see that happening? And I think it matters because of the implications it would then have across the real estate sector and offices and all of the above.
You know, it's hard to say. Historically, there's been a lot of prediction technology eliminates the need for work. What it's done is eliminated some needs, expanded others. I think there'll be some of that. I think there's a potential as you get further and further out that maybe the aggregate work hours go down. The good news to your point is the real world still exists. And so people are going to do physical things as well. And interestingly, infrastructure, which has been a great area for us, physical real estate, some of the entertainment, amusement parks, water parks, those things are going to stick. You're not going to do those virtually, I don't believe. So in the near term, I still see this technology in many ways, it's eliminating certain jobs, but it's creating others. And you know, we own a business, Ancestry.com, and you think about what that experience could be like where it starts to create movies and captures the music and the newspapers. And therefore, what it's creating to the end user experience is different, and it's going to require some human interaction as well. Obviously, other functions may not. So I think as investors, again, back to the beginning, what's going to happen with tariffs this week? I don't know. Will the Fed cut 2 times or 3 times? I don't know. But this technology and the way it's going to change our lives, I think that's profound. And thinking about these kind of big trends, that's what I'd focus on as an investor.
I want to ask you about a part of your business that I don't think that people ask you about enough. it's the business of hedge funds. We just heard from Dawn Fitzpatrick on the big picture here in terms of where the industry is going and how the multistrats are getting so big, but you seem to be finding a lot of opportunity elsewhere.
Yeah, it's interesting. So our hedge fund business is primarily focused on absolute returns. The division is called BXMA for us. It manages a little more than $80 billion of capital. Joe Dowling, who ran the Brown Endowment and was a hedge fund manager himself, runs the business. And what we're really focused on there is cutting off the downside for our investors and having things that are not correlated with stocks and bonds, because our investors already have a lot of that, doing it in a liquid way and still delivering an attractive absolute return. And we managed to do that. So since Joe joined us 4 years ago, we haven't had a down quarter. We've outperformed 60-40 by 1,500 basis points. Last year, we were up 12% net. And we're doing it in this very uncorrelated way. And I think as cost of capital comes down, as base rates come down, I think investors will look for things like this as an area. I think historically in the old long-short equity days, people were looking for hedge funds to outperform equities and have downside protection. I think the business has evolved. And if you can have this piece of your portfolio as ballast, it makes a lot of sense. A number of the biggest endowments have as much as 20% in absolute returns. So this is an area we really like. And like everything in our business, if we deliver good returns, if we deliver for our customers, we tend to attract capital. And that's the key.
But are you willing to fight against the notion then that it's multi-strat or nothing in this environment?
Well, I think the multi-strats have done a great job. I mean, if you look at Ken and Izzy and the businesses they built and the performance, you can't argue with that. But it's a big world. And we can do things a little bit differently. Our approach is different. We think we can offer something attractive to clients. And if we do that, we think we'll find capital. And it can be across quant and macro and long-short equity and credit. And if you can deliver investors a basket of that, uncorrelated with an attractive absolute return, I think that's something that should do quite well.
So we have spent a lot of this time thinking about investment opportunities that exist in today's environment. If you can name probably the biggest shift heading into the next couple of years that you're trying to capitalize on, what exactly is it?
So in our business, I'd say it's a couple of things. First, it's the movement to private credit, which is essentially bringing investors directly up to borrowers. It could be non-investment grade direct lending or investment grade, in many cases, insurance companies doing things like consumer loans and infrastructure loans and energy loans, fund finance. And in that process of bringing them sort of farm to table, you can generate higher returns. And we're seeing, whereas in the equity bucket of most investors, private assets became a very large piece. Credit was pretty much all liquid, other than distressed and opportunistic. And this feels to us like a secular change with a lot of runway. The other area I would point to would be the individual investor. There, we have grown to $260 billion for individual investors. And again, institutions who are a third or more allocated to privates, even wealthy individuals, are only about 1%. And so the advent of these perpetual products across real estate and private equity and infrastructure and credit, and doing it in structures that have a little more liquidity but are still semi-liquid, don't have the drawdown features. These sort of products, if we can deliver outperformance, I think will continue to be very attractive. They've grown quite a bit. I think they'll continue to grow. But again, in both of these areas, I'd come back to our true north. We've got to deliver for the customers. If we do that, I think we'll continue to see major investors take a larger portion of their portfolio and move it into private assets. And at Blackstone, we should benefit from that.
John, I have a million more questions for you, but we have to leave it here. Thank you for joining us here on set in such a crazy day. Thank you.
Thank you, Sonali.
You can build with Blackstone, invest in our funds, not just in fixed income. I really think you're missing out.
Please welcome to the stage Raymond J. McGuire, President of Lazard, and Robert E. Rubin, Senior Counselor at Centerview Partners and the 70th U.S. Secretary of the Treasury. for a conversation with Bloomberg's Lisa Abramowitz.
I want to welcome everyone here, and this is a forum to talk about investment ideas and a frame of reference. And we have the task of explaining how to navigate the current business climate. And these two gentlemen will explain to us how we can frame the current events that we're facing off with and how companies are grappling with them at a time where the business climate changes in 30-minute increments. Joining us here is Ray McGuire, president of Lazard, as well as the 70th U.S. Secretary of the Treasury, Robert Rubin. They have both told me that I can call them Bob and Ray, or Your Honor. I want to start with this question of where are
Your
we?
Honor, if you want.
Roberto.
That's Bob. That's what it is. Yeah.
Bob, Your Honor.
There were people in Congress who called me things far south of Bob, I'll tell you.
Well, hopefully we don't go there. But I do want to start with just where we are in the day's news, which is the tariffs, and this idea that we got 25% tariffs actually put on Mexico, on Canada, an additional 10% tariffs put on China. I want to start with you, Ray. How are companies making sense of this?
You know, it is we're in the early stages of this tariff diplomacy, if you will, geopolitical diplomacy. And boards and senior managements are now trying to assess the implications. It's been advertised for a while, and today it's begun to be implemented. Having said that, there's also the suggestion that in April there's going to be a reset, so there'll be a review. And most investors, most companies do take a long-term view. And so we'll see how this early move on the chessboard plays out. People are assessing, companies are assessing the implications. But for the most part, there's a long-term view that is now being contemplated. We've not seen this level of tariff, at least in modern times. We've seen it historically, the implications of which historically have been pretty dramatic. And we'll see today whether or not the implications are going to be equally as dramatic.
Bob, how do you take a long-term view when it's unclear what the destination is?
Well, I have the following view. I think these are going to adversely affect us with respect to inflation. They'll adversely affect us with respect to growth, adversely affect productivity. But I think there's an even bigger point in some respects, Lisa. We have treaty obligations with Canada and Mexico, and we have now violated congressionally approved treaties. What does that do to our credibility around the world with respect to our commitments? And that can adversely affect us geopolitically and adversely affect us economically. We have spent all these years since World War II developing alliances and allies, supported by all sorts of commitments on our part, and it's been enormously in our economic self-interest, all in our economic self-interest and our geopolitical self-interest. And I think we're putting all that at risk.
Ray, do you see companies thinking about it that way, or dealing with international partners who are calling into question some of the framework of being able to come through with
the answer is that, and I agree with Bob, companies are being forced to now contemplate variables that historically we haven't contemplated. Remember, the peak of U.S. manufacturing happened in 1979. Between 1979 and today, we have relied on a supply chain that has been so dependent upon our international partners, especially our closest one being Canada and Mexico. And so as that begins to be challenged, how we onshore, or at some point we talked about nearshoring, and nearshoring was Canada and Mexico. Since we've now applied tariffs to those countries, it's unclear how U.S. manufacturers will navigate. So we're exposed. The corporate America is exposed, especially those in the industrial arenas. Technology, perhaps a little less so, although we have exposure to what's taking place on the chip front. But the implications here on the market we've seen today, you've seen a sell-off of $2 to $3 trillion. Risk is off today. Before today, you had a little bit more risk on. You look at the volatility index, which is the VIX. Historically, it's averaged 20. Now you're at 25 or so. If you look at the options on VIX 50, which gets to the high end of risk, we see more activity in those options than what we've seen in quite some time. So you now are in a relatively complex environment with interdependency having to do with the supply chain for all the goods and all the products that we consume. We're going to have to be able to manage through that.
Bob, you mentioned that this is going to cause inflation, and it's also going to cause some sort of deceleration in growth. People argue that tariffs in the long run are disinflationary. It's a one-time price shock, and then it gets absorbed, and it's sort of part of the mess to get to a final goal of bringing more domestic production, reviving more domestic production. What's your outlook? Do you think that it's going to look a bit different than that?
Well, to be a little bit technical for the moment, Lisa, you're right. It's a one-time supply shock, so that increases costs. And then it can level off, so the rate of inflation may not have gone up, but costs will be higher. To consumers, to our producers, the producers who compete with imported goods can now raise their prices. And I think in terms of the long run for us, I think it means less productivity, because the whole theory of trade is comparative advantage, so that every country gets the benefit of getting the most it possibly can for that which it is best suited to produce. And now we're interfering with that process, and it will cost us in terms of productivity and growth. I think this is about ideology, the decisions. I think it's about ideology, and I think it's not factor analysis grounded.
It raises this question about a time when, heading into this year, companies were talking about incredible dynamism, incredible expansionism, the idea of American exceptionalism. We were going to see a boom in deal making. Ray, do you think that that's just on hold, that that can come back? Or do you think that people are rethinking that in corporate executive offices?
Well, let's be clear about productivity and how it is that we transition. In order to rebuild the industrial infrastructure of this country, it'll take 5 to 10 years. So while we think about being able to remove ourselves from that supply chain dynamic, the reality is it'll take a while before we do that. Having said that, as I think about some of the tailwinds in this environment, you have, I don't know, $10 trillion sitting on the sidelines, $7.5 trillion on corporate balance sheets, $2.5 trillion with the asset managers. You have $14 trillion or so of debt available, $2 trillion with the asset managers, $12 trillion with traditional banks. Will we need to somehow deploy that capital to continue to grow? The answer is yes, we will. So I have, on the one hand, a lot of capital that is pent up. On the other hand, notwithstanding the sell-off that we're seeing in the market today, which brings it back down to still what is a pretty historical high. We're trading at 20-some-odd times next year's forward earnings. So I look at the dynamics of the resources that we have and how we deploy those resources and the pent-up demand for growth. So we will pause for a while as we understand and interpret the implications of the tariff dynamics. And once we get to a new normal, then at some point we will re-engage. Will it be at the same levels that we've re-engaged historically? Unclear.
Yeah, but do you think that we're going to have that boom in M&A, that boom in deals that everyone was expecting that's been propelling financial stocks higher?
Well, we had the prospect of that, didn't we? When we came in, we thought that there was going to be, because of the factors of the availability of capital, where the market was going, and we also thought there was going to be a relaxation in some of the regulatory environments having to do with what took place in the M&A environment last year, where regulators came in and upset a few of those transactions, said no to a few, implications which are pretty severe on a few of those companies that were not able to merge. And given the pent-up demand and demand for growth for these companies, I think you will see some once the first move in the tariff environment, once that move gets digested. The implications of which are still going to be long-term, as Bob referenced.
Well, and Bob, something that you talked about is that one of the foundations to the business climate in the United States has been some level of predictability.
Is what?
Some level of predictability.
Oh, boy. Yeah, and I think what we're doing, absolutely, Lisa. And I think that goes even beyond that. The rule of law underlies our economy. And I think and that gives you certainty and predictability. And I think a lot of what is going on is adversely affecting confidence. It is now, and I think will more so in the future. Confidence in the rule of law. This whole discussion about retribution and the use of the law enforcement agencies of the United States to attack our opponents rather, the administration, is a good example. I think just, as I said a moment ago, I think the violation of our treaty obligations to Mexico and to Canada. So yeah, I think that predictability and confidence are essential and underlie rather our economy. And I think another good example, if I may, of something I think is doing tremendous damage, which is DOGE. I have spent my entire career focused on fiscal discipline. We balanced the budget in 1998, first time in 30 years. I think we knew what the heck we were doing. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government and to the recipients of government services and government activities. Now, are there excess expenditure? Are there inefficiencies and is there excess regulation? Yes. But you approach it with a rational cost-benefit analysis, not a burn and the burning down of what exists, and then the thought that you rebuild it. And I think we really are doing tremendous damage to government and to our economy.
Ray, you're nodding. Do you want to add in? Or you're like, no?
The answer is, the response is, as you think about the world, geoeconomically and geopolitically, the anchor, the sacrosanct anchor that the U.S. has is rule of law. It has never been a factor in any conversations that we've had up to this point.
Is it a factor now?
It is moving into the conversation in ways that we haven't visited historically. So we need to be very mindful of conversations that today, it is not central to the conversations, but it has now become part of the conversation where historically it hasn't been.
One thing that some people would argue, the Trump administration argues, is that this is an effort to rearrange a system that has been structurally disadvantaging the United States, especially when it comes to China. And they make the argument that you need to play tough and do different things to try to shake up the status quo. Are companies still talking like that? Do they expect this to just be a negotiation, that they're, to Ray's point, Bob, that there will be a new normal that will emerge, and that the second half of this year will have a more stable kind of foundation that's more visible for corporations?
Well, what kind of a new normal do you want to have, Lisa? I think that the norm. No, I'm serious. I think there's a new normal of irrationality, and I don't think that's going to be helpful to our economy. I think our new normal ought to be to return to sensible cost-benefit judgments about everything that we do in terms of public policy, and I think we're doing exactly the opposite right now.
What we're hearing from companies, Ray, is that there could be some reasons behind some of the tariffs, and some investors have come out and said that tariffs are a tax, but some have said,
Well, they are a tax.
Some have come out and said that, that they can manage through this. The U.S. economy is strong and resilient, and once we're past this negotiation tit for tat, they can continue with the growth plans, and they still are optimistic about the consumer. Ray, have you heard anything different than that?
I think there is optimism still, but optimism maybe without the same level of conviction, right? So the randomness that appears to be at play here is not one that gives boards and CEOs a lot of confidence. So whatever the new normal is, will they react? The answer is they will react whenever we get there. If it's a new normal of continued unpredictability, then it's not quite certain how aggressive people are going to act. So I would continue to pay attention to the volatility index. I would continue to pay attention to the 10-year Treasury, which I think what the administration is currently looking to as guidance, and see if we get to a new normal, what that new normal looks like. It's not clear yet.
Bob?
Yeah, and if a new normal, Lisa, is a new normal in which the world has tariff walls, we have, because after all, we're going to have retaliation. We're having retaliation already. We'll continue to have retaliation. And if the new normal is a world of tariff walls, then we'll all just be less productive, less efficient, and less effective as economies. And our people will, as a result, do less well than they would otherwise have done.
You mentioned the 10-year Treasury yield, and Scott Bessent has made it, the Treasury Secretary under Donald Trump has made it very clear that the 10-year Treasury yield is his North Star in some ways, that he wants to bring yields lower. That is a requirement to deal with the deficit that we have. Is that how companies are thinking about it as well? Is this how people are thinking that actually 10-year Treasury yields lower?
How, pray tell, does he plan to do that? Seriously, this is something I know a little bit about.
Oh, yeah.
How, pray tell, does he? No, I'm serious. I was at Goldman Sachs 26 years. This is what I did for a living, and I was at Treasury for 1 year. How does he want to bring 10-year yields down?
Well, he says that according to his plans, that there will be greater efficiencies through Doge, but also through cost cuts.
Doge isn't going to create greater efficiencies. What Doge is going to do is tear apart our government.
But then he also
What you need are
says-
greater efficiencies, and the way you do that is you look at the excesses in both regulation and government, and then you approach them with a reasoned cost-benefit analysis, not slash and burn.
Well, the 10-year Treasury yield has been down every single week since
What?
Donald Trump. The 10-year Treasury yield has been down every single
Yeah,
week.
because people are starting to worry about the economy.
So then I would ask you, Ray, at a certain point. No, and I
I'm now being excluded from the conversation.
I want to go back.
All right, no, I'll sit here totally quiet.
No, I would love to have to further the conversation.
Oh, that's what I'm yielding to the
I know.
secretary. And I'm looking at the chart here, and unfortunately, he happens to be right. So.
Well, no, this is really the key question. And actually, to your point, there has been this theory that if yields go down, you end up with more economic dynamism because companies will invest more. And that has been the Fed put, right? This idea that if they lower rates, that will encourage people to spend more. That is not what we're seeing in markets. That is the opposite. What we're seeing is yields lower, risk off, people scared.
Yeah, exactly.
To your point. And Ray, to your point, from your perspective, do companies see yields lower as a positive shift before when we were talking about the potential for rate hikes? Or are they growing increasingly concerned, to Bob's point, that this really represents a pretty massive and seismic shift in the economy?
Remember, we're responding real time, right? I got a pretty low 10-year, and I got a stock market that sold off $2 to $3 trillion today, and a VIX that's gone up by 20%. So the data is, and I got a conference call that's taking place now up north. And I got one that's going to take place
tonight.
Not letting you leave. I got one that's taking place tonight that we're all going to witness. So the question is CEOs are waiting to digest as much, and boards are waiting to digest as much of this information as they can, and then somehow position themselves for what the world is going to look like after the next 2 days or so. But it won't be just that. They have to look at the entire supply chain infrastructure and how it impacts what they do, as will the U.S. consumer. And if you go through and look at the implications on the large retailers out there, both electronic retailers and food retailers, look at consumer staples. For some reason, consumer staples are up. I'm looking at some of the companies with which we interact every day, and their stock seems to be moving in the right direction. Well, right direction means the stocks are moving up. And I'm looking at this, and you're looking at you're looking at the VIX here.
It's easier sometimes to talk about what the market's doing than to
You
really
have a
weigh
bot working here, so it's something that we suggest you put a slide up.
You can just keep talking about this, Bob. I want to come back to you about this idea
I thought you were excluding me. Now you want to come back to me? I may not engage, having once been excluded.
I think you'll engage.
You nailed it on the yield, so she's a little bit.
You're talking about how you have quite a bit of experience as being the Treasury Secretary.
Ton of experience, but go ahead, yeah.
And you said, how is he going to bring down 10-year Treasury yields? And right now, we see them dropping.
The best way to bring down treasuries is to have a sound economy, and then have, in response to that, have sound monetary policy, and then have treasury yields adjust accordingly. You don't want to have yields go down because people are concerned that we're going to have a weak economy or that we may run into growth problems.
It raises this question, even if these tariffs come off, even if they're rolled back.
If what rolls back?
The tariffs.
Oh, I'm sorry.
If they are being used as a cudgel of sorts, how long can this uncertainty remain before just the idea of having uncertainty is really pernicious for growth?
Keynes famously said that confidence underlies economic activity, and confidence is predictability. And I think that the actions we're taking, the tariffs, the immigration actions that we're taking, what we're doing with DOE, which, as I said, I think doing tremendous damage to government, and ineffectively addressing what is a real problem, which are inefficiencies and excess regulation. I think all of that have not only substantive effects, but adverse effects on confidence and unpredictability. And I think all this talk about retribution, of which there's been a lot of talk, I think feeds that lack of confidence and unpredictability.
Ray, from your perspective, how long can this go on before companies that are delaying some of their investment plans just take them off the table?
You know, I think it's early days. Again, I think you're in the early innings of this tariff diplomacy, and companies are pretty wise and thoughtful about how they engage. This still remains the largest, used to be the fastest growing economy that exists on the planet, so there's still confidence in what's taking place in the U.S. Notwithstanding the lack of predictability. A lot of reserves, a lot of capital reserves, a lot of pent-up capital that needs to be allocated. So I don't think there's going to be a rush to judgment. Having said that, the more the actions are unpredictable, then that goes to the level of confidence that exists with senior managers and boards. They will wait this out to see what the implications are and how severe are the implications, and then take a decision on how they're going to move forward.
Is the United States still the best place in the world to invest?
I would rather, that's a good question, Lisa. I would rather invest here than any other economy, but of course that a little bit reflects on what's going on elsewhere, China, Europe, et cetera. I mean, those are all places with tons of problems. But having said that, I think it's the greatest uncertainty. Having said that, I think it's the greatest uncertainty in the 26 years that I've been involved, or rather 60 years roughly, that I've been involved in decision-making in one sort or another with respect to markets and economies. And I think those risks have been substantially increased, as we discussed briefly, by the actions of the administration or the prospective actions of the administration. I think one other thing, if I may, Lisa, I think we have an unsustainable fiscal trajectory. And I think that, that is what the administration says. The problem is I don't think they go at it the right way. I think you can be rational about trying to save some money, and I think we can save some. But I think as a practical matter, that is a very limited, an opportunity, but a very limited opportunity. And fundamentally, we need more revenues. And if you look to tariffs for revenues, you'll get more revenues, but you'll be adversely affecting growth. And the offset of that is probably, and I've had this modeled for me actually, the offset of that is a very small, if any, net increase in revenues. But the answer lies predominantly on the revenue side.
Ray, your thought about whether the United States is still the place that everybody wants to invest?
You know, without reservation, longer term, yes. If I look at the advances that have been made in technology, the Max 17 examples, if I look at all the advances that we're making across the landscape, notwithstanding our dependence on supply chain in many ways, this still is the most attractive, the greatest country that exists.
What about next 6 months?
We're going to go through some challenges over the next 6 months. We'll be challenged. Will we get through them? The answer is yes, presumably. Now, the challenge I have is that it's a historical mindset. We've not seen factors come into play historically the way we see today. And so, and I say that with a bit of conviction, not necessarily the hope, but a bit of conviction. Hope will always be there, but conviction that we'll get through this.
We're out of time, unfortunately. I could spend all afternoon with the Honorable Ray and the Honorable Bob. Thank you so much for taking the time. Really appreciate it.
Thank you.
Don't use the playbook for the last 10, 15 years for the next 10, 15 years.
Please welcome to the stage Nir Bardea, CEO of Bridgewater Associates, for a conversation with Bloomberg's Sonali Basak.
So Nir, people had heard you just say this, and I was paying attention to this too, because it was the last time you spoke to Bloomberg. You said that the playbook used by investors for the last 10 to 15 years can't be the same playbook that you use for the 10, 15 years ahead of us. And I've been thinking ever since, what is Bridgewater's playbook?
So just a expand, because I think things played out basically in that way. And we look at markets today, you look at the last month, and just to lay out how the world has shifted and therefore how Bridgewater has aligned itself with the shifts in the world. There are three big shifts that we've been watching. One, and I'll go through that really quickly, there's a macroeconomic paradigm shift. That's what I was talking about back in Doha, where we've come out of a period of decades of globalization that started with the fall of the Berlin Wall, China joining the WTO, that led to expansion of profit margins and enjoyed kind of disinflation. That was a long period of excessive gains in the world. And the problem is that those gains were distributed very unequally. They led to the rise of China. They led to emerging markets economy enjoying it, but they also led to the hollowing out of the manufacturing base in the middle class in the Western world. And as a result of that, it started a political shift that ended up bringing a new regime here in the US, in Europe, in Canada. And back then I was saying, hey, look, this tailwind that we're enjoying now is gonna end, and you have to embrace that change in the macro paradigm and prep yourself for a different reality. I said other two quick things and then kind of touch on how Bridgewater has aligned itself for it. The second thing that has happened during that time is that while wealth got distributed, I talked about Asia and China, the Middle East, portfolios actually got a lot more concentrated. If you look at our institutional investors, they have more than doubled their allocation to private assets. Even if you look at their liquid part of the portfolio, unbelievably concentrated in the US. I heard the questions kind of at the end of the last interview of, is the US still a great place to invest? Well, a lot of the investments has gone to US equities. 70 cents of every dollar in equities has gone to US equities. And that means that they are incredibly vulnerable going to this new economic paradigm. And the third thing, which I know we're going to talk about more a little bit later, is all this is happening when we are facing a once-in-a-generation technological disruption. We've been talking about AI for a long time, but it's here. The intelligence is here. And the macroeconomic impacts of that are just trickling in. So CapEx this year will double last year, and it starts to move the needle, but the questions around productivity and therefore employment and social implications is still outstanding. Bridgewater's playbook has been looking at this for a long time and saying, how do we position ourselves across these three things in order to be there for our clients when they need us most? And I'm happy to talk about that more.
Yeah, let's start with the last piece of that, because on a day like today, maybe everyone's thinking about the short term, but the long-term trend has been thinking about what AI would do. What is the good, the bad, and the ugly of it all?
So, man, there's so much words that are being said about this topic. And I'm going to add some words on top of that, but I'll kind of give you our framework to thinking about it. We've been forever thinking about the best combinations of humans and technology. Because if you think about our mission is to understand how the world works through combining humans and technology, because no one human mind can wrap their head around everything in the world. And that means that we've always searched for how technologies can replace what humans are doing so humans can do what technology can't do. And what I can tell you is that I think it's a fool's errand to try to be precise about how this is going to play out. I'll give you two examples of that. When I said technology is here, you know, one school is saying we are headed to full agentic AI, which means we will sit back and everything is going to be replaced by AI. That could happen. Others are saying this is going to be a general purpose technology, which is still very impactful, but it's wildly different than fully agentic AI. And people can be very specific about where they think that's going to land. I don't think anybody knows. And the most important thing is to prep yourself for a wide range of outcomes. I'll give you another example, which I think is really important to kind of process with regards to the macroeconomic paradigm that's shifting. And that is that, you know, the optimists say, yes, we are in a modern mercantilist world, meaning the opposite of globalization, a world where we have less efficiencies because governments are trying to avoid the vulnerabilities of globalization. The optimists say, well, we are headed to a productivity miracle. It's going to be great because these technologies are going to more than offset whatever we lose from the less collaborative world. Okay, that could happen. It could totally happen. But the pessimists say, hey, the reason we're here in the first place is because there were massive gains in this macroeconomic paradigm that were distributed very unequally. We had big winners and losers. Well, the pessimists say AI is going to exacerbate that tremendously. When we have massive winners and losers, it's going to be disruptive to society. How those things net out has such a wide cone. And I think, again, it's a fool's errand to kind of try to predict exactly what's going to happen. So my advice, and what we do at Bridgewater, we try to be practitioners. So get your hands dirty, understand the technology deeply, and then prep yourself for a wide range of outcomes of how this could play out.
Speaking of getting your hands dirty, Bridgewater has been using AI for its own processes. Late last year, you launched a fund over at Bridgewater, starting with $2 billion, that uses machine learning as the primary basis for decision making. It was built on proprietary technology. What have you learned from this in terms of how machine learning-based investing is different from human-led investing?
So I'd say I feel very lucky. Because of Bridgewater's DNA as we're coming to this inflection point. I said earlier, from the 80s, the idea that no human brain can possibly get their head around everything in the world meant that we always try to replace humans with machines. So we are not moving from a human-led investment process to a machine-led investment process. We were using scientific calculators, and then we were using Excel sheets, and then we were using the most complicated expert systems. This is AI before AI. To make investment decisions in a systematic, fundamental way. So for us, this is another step along an arc. And what we have learned through this process of what we call AIA, this is the Artificial Intelligent Investment Associate. That's a strategy that we rolled out in the beginning of last year that does the same thing our people do, but in a machine learning first way. We learned through scientific breakthroughs within Bridgewater that you can reason, that you can generate alpha in a machine learning first way. That strategy competes with our expert system in humans and generates unique alpha that is uncorrelated to what our humans do. That's been running now for a year and a half, and it's comparable. And that's mind-blowing in the space of possibilities of what could happen. And so one last thing, beyond the numbers that are happening this year, or in any given short period of time, the most important thing is it keeps us up to date on where things are going, not only within the asset management industry, but also as you think about how this is going to impact the macroeconomy.
So it's interesting, at the time of the launch, your co-CIO at Bridgewater, Greg Jensen, said the fund had the potential to change the hiring and composition of staff. What skills do you think the future employees of Bridgewater are going to need? And we were kind of joking a little earlier, maybe the junior analysts don't go away, but boy, do they have to be doing something different.
Which has always been the case. Truly, because when you have an expert system that does a lot of what humans do in other funds, as an example, you really start to move people to do what machines couldn't do. So we have been shifting the type of humans we bring into Bridgewater for 50 years, and that means from really looking for analytical skills and financial backgrounds to people that are conceptual and can ask philosophical questions and query, as an example, because they're going to be very levered with technology and how they explore their questions. That's been constantly moving, and I think this is a big shift, but it's a big shift in the same direction of what can humans do, the future analysts? What can they do that machines can't do? I'll say the one thing that is on my mind that I'm worried about. When you think about that arc, you have to think about what trains people over time. So there are basic jobs that people have in many places where you sleep under your desk and you do the tough work that then leads you to be able to do the higher level, more conceptual things. One of the things we're thinking about is, hey, we are well positioned already to replace a lot of the basic tasks with machines, but what does that mean to talent development over a long period of time? You have to be conscious not only of today, but what does it mean for your talent strategy over the long term?
How does this fit into the broader trajectory of Bridgewater? When I think about where you stand today, you've inherited this firm that's now roughly a half-century old. How do you position the firm for the future? This is all in the scope of positioning for the next 50 years. What is Bridgewater 2.0?
So I think the best way to hit this is to go back to the three things that I've said, because it's where our heads are at. There are things that are the bedrock of Bridgewater. Bridgewater truly, and I think I said this on this stage years ago.
Just after you were named CEO.
Yeah, with Eric Schatzker. Bridgewater is about getting an incredible group of people together and have this very, very unique culture that puts in the center of everything the desire to be excellent and constantly learn. Because that's the only way to accomplish this incredible mission of mapping the deepest understanding of how the world works in a systematic, fundamental way through a combination of humans and technology. That stayed the same. If you look at the three things that I've said, I said the macroeconomic paradigm is shifting, and because of that, that means that beta, the tailwind, is done. Alpha generation, the positive, uncredited alpha, that pure alpha is an example, return for 33 years, is more important than ever. A deep understanding of cause-effect linkages of how the world works, more important than ever. We have to hold the hand of our clients in days like today and months like the last month, where they're asking, how are these new policies going to flow through the economy? What's going on? So tremendous focus on improving the quality of our understanding in our alpha. I said the second thing is concentrated portfolios. For 50 years, you've said this, we're celebrating our 50th year this year. It's always been about partnering with CIOs and CEOs of the largest pools of capital in the world and helping them achieve their goals. These are investment goals, resiliency, diversification. We've been very, very focused over the last couple of years to make sure that we can increase the impact across their portfolio, because their allocation to pure alpha is going to be small, but in $1 trillion portfolio, they're going to want to know that you have the capability to invest, not in the US as an example. If everybody's investing in the US, we've been really focused on building the capability to invest in China as an example. Our onshore strategy last year returned 30%, and I say that not because of the number, I say that because it shows where our focus has been. And the last thing is what we've talked about, which is in a world that technology is going to disrupt us tremendously, making sure that you have a partner in Bridgewater that is the curve, that is where the scientific breakthroughs are happening, that you can lean on to show you where things are headed. Those are the big three areas that we've been focused on.
Now, we'll get back to where things are headed, but before we get there, I just want to give the audience a chance to get to know you a little bit, because the more I've learned about you, the more your story is kind of like nothing I've ever, it is like nothing I've ever seen in finance. So you didn't graduate from high school initially. You eventually went to Wharton, and then you started at Bridgewater as a 33-year-old intern. How?
I mean, Sonali, my Jewish mother, for you saying that I didn't graduate high school on this stage is probably like, her heart is broken right now. but it's true. And I've never shared this, actually. So I've said many times that I look different. I know I'm different. The amount of people that commented on the fact that I'm not wearing a tie today. I am different. I come from the other side of the world. I come from Israel. I've talked historically about being a third generation to grandparents that were Jewish refugees, family that was murdered in the Holocaust, and I talked about how the story of my life is connected to seeing them establish a country. And I talked about how an incredible group of people with values can do incredible things. And I always jump the story and say, and then I ended up in Bridgewater. To your point, if you double-click on that story, and I've been reflecting on this a lot lately, I was a bad student in high school. I didn't get a diploma in the end of 12 years, and I was very, very lucky that in Israel, there is a mandatory service that everybody has to do at the age of 18. And because people like my grandparents that come from Libya and Hungary and Poland, looking different backgrounds, different languages, needed to come together to accomplish this really incredible task of putting a country together, they knew they had to make the most out of the total human capability and do that through the service. So the service ignores everything that happens up until the age of 18, and based on your merit, reassesses you. I tested at 18 thinking that I was incompetent and tested extremely highly. And that changed my life. It led to a very successful service. And the reason that's important is because 15 years later, you're right. I'm a 33-year-old, already with gray hair, winter intern at Bridgewater. It's me and 6 other hungover Dartmouth 20-year-olds. And my English is not great, and I'm out of context, and it's pretty confusing, and to say that I feel lost is not even the beginning of it. But again, I'm at an organization that is trying to make the most in a meritocratic way out of the human capital that it has, because they're trying to accomplish this incredible goal. And it leads me to kind of 3 big lessons. One, luck matters. Luck matters. I was lucky to be in a society where I got a second shot in the service, and I was lucky to come across Bridgewater. I could have come across a different organization. The second thing, and I connected back to the AI point that you talked about, differences in thinking and unique contributions are very valuable. And I think that's especially true in a world where a lot of the generic intelligence is going to be commoditized. And the third thing is the way to capture unique ways of thinking is to aspire at least to have a real meritocracy. That's true in Israel. It's true at Bridgewater. I think that is a key in us unlocking and facing some of the biggest challenges we have as corporations and as a society.
So another major part of your background, as you've been talking about, is your Israeli heritage. And you were talking about complicated geopolitics. In the past year alone, you've been back to Israel. You've spent a lot of time in the Middle East, including Saudi Arabia, Qatar, Bahrain, all in your capacity as the CEO of Bridgewater. What can you share about the trajectory of the Middle East, and do you see a path to peace when it comes to the conflict in Israel?
Wow. Let me start where I feel like I have to. October 7th is incredibly personal for me. And not just October 7th, but also what happened subsequently. There are still 59 hostages in Gaza. There's suffering in Gaza. There's suffering in Israel. There's suffering in the entire region. These are family members, my community. This is my community of Bridgewater. Some of them are neighboring countries. These are partners of Bridgewater in neighboring countries. It's been a year and a half of trauma, truly trauma. And my heart goes to everyone on this. It is important for me to say that I'm proud to be Jewish. I'm proud to be Israeli. I'm proud of my country, men and women, and I feel very lucky that I've had the chance in this job, to your point, to go around the world, and including in the Middle East, in places that matter, and represent, hopefully, the best of Israel, and learn about the best in many of the countries that you've mentioned. Forge real friendships with people and incredible, incredible leaders. And to your question about where things are headed, I've said this before. I have a deep belief that, look, tragedy and trauma and suffering leads to resiliency. And resiliency leads to evolution. If you look at the Second World War and the New World Order that came out of it, if you look at the Great Depression and the new economic paradigm that came out of it, if you look at the Holocaust and my grandparents, rising from the ashes and building a country, if I said that a great group of people can come together and share values and forge a different future, I go back to all the people that I've met in the Middle East, not just in Israel, but in Saudi Arabia, in Bahrain, in the UAE. There's an incredible, resilient generation that has suffered a lot. And I am actually more hopeful than ever that that generation can create a completely different future going forward in the Middle East and a 100-year peace.
What role does Saudi Arabia, does Qatar, does the U.S. play in negotiating peace here? And is there a 2.0 version of the Abraham Accords?
I mean, that's really not for me to answer. The thing I would say is, yes, I think that Saudi Arabia, the U.S., the UAE, Bahrain, when I say there's a generation of leaders that when I talk to these people, they're just like me. They have the same exact aspirations as I have. And I think a coalition of that group of people in Israel and in the region is the way to create what you call the Second Abraham Accord, and it's coming. I'm more hopeful today, Sonali, honestly, than I've been 5 years ago. Because out of this suffering, there's a crystallization, the realization that creates the necessity to evolve and take the region in a different direction.
And I want to get your thoughts clearly on this, because the human toll has been devastating both in Israel and in Gaza and beyond, really, at this point. How do you see the conflict playing out, given that the ceasefire talks have stalled?
Wow, if I said that it's a fool's errand to guess where AI is going, this is truly a fool's errand to guess. But I would say this: until the hostages are released, there's no solution. Also, until there is a future for the Palestinian people, there is no solution. And there are solutions that can be put together, but they will be put together by a new generation taking leadership and coming together and making sacrifices that previous generations were unwilling to do.
You know, a lot of people look around and they say, in the wake of World War II, when you look now, there are a lot of the protections that were put in place to make sure that the world didn't fracture again. Some of those protections are now under threat, particularly with the changing guards across countries. Do you worry about that?
I mean, personally, yes. I think that's a part of the macroeconomic paradigm that is also a geopolitical paradigm that has shifted. The world post-World War II, out of the trauma of World War II, started a series of events that led us to not only put protections and institutions, but increased collaboration decade after decade after decade, leading us to a long period of extreme collaboration over the last 30 years. There is no question that that paradigm, geopolitical and macroeconomic paradigm, is being undone. Now, there are reasons why that's getting undone. There are problems that were created that I mentioned earlier in this conversation that need to get fixed. But if that's not done well, you can, instead of correcting the problems that the system had, you can create a disaster. And I worry that, between correcting the problems and causing complete chaos, we can easily end up being in chaos.
Before I let you go, this is kind of another bummer of a question, so I apologize, but do you think the world is more dangerous today than it's been in a long time?
The world is more dangerous today than it's been in recent history, but I think this is one of the problems that we have as humans. If you go back, not that long, go back 150 years. If you're in the US in the 1800s, it is tough. You have militias, women have no rights, black people have no rights. Then you have the Spanish flu, then you have the Great Depression, then you have World War I, World War II, you have the assassination of Kennedy and Martin Luther King. We have a bias to remember the last 30 years, which were particularly calm. So the world is more dangerous today, but this is not a bigger problem than we have seen in the history of our parents and grandparents. We can deal with this as long as we embrace reality, understand it well, and come together to find solutions.
Thank you for such a clear conversation. That is Nir Bardea, of course, the CEO of Bridgewater. Thank you for your time.
Thank you, Sonali. It's great to be here.
What a morning of discussions. I can't even remember what day it is sometimes, considering how much has happened since we woke up today. I hope you all are enjoying the conversation so far. I know I'm enjoying the interviews as well. It's lunchtime. Before you head off, I have some important directions for you, so bear with me for just a minute, because most of you, you're going to head out these doors, turn right, go downstairs for our general lunch. We have a special treat for you there this year. Bloomberg Intelligence's top analysts will be sharing their 2025 outlooks exclusively for you, all in person today. They will be leading some networking conversations at tables on global equities, private credit, ETFs, and more, and they are the smartest people that I have ever met in my life, so please be sure to talk to them. Also, while you're downstairs, visit Invesco QQQ and their new activation, Race for Innovation. It's a first-of-its-kind game that gives users a chance to race against each other, all while learning about their ETF products. And if you're registered for the Drivers of Return Lunch, proudly sponsored by Invesco QQQ, you can head out these doors and continue into the hall where you first walked in today. That session is located in Hub 1. And I will see you back here at 1:45 p.m. sharp. We have a huge afternoon. We have Gary Cohn, Fed President John Williams of the New York Fed, Apollo President Jim Zelter, ARC's Kathy Wood, and many, many more. We'll see you soon.
Didn't save you a seat, just find a lap to sit on, and you'll get something to eat. When they serve the tea, watch the sugar dissolve. Just don't go confusing sugar with love. Sugar man, sugar man, sugar man, sugar man, sugar daddy, sugar daddy, sugar daddy, sugar daddy, sugar man, sugar man, sugar man, sugar man, sugar daddy, sugar daddy, sugar daddy, sugar daddy, sugar man, sugar man, sugar man, sugar man, sugar daddy, sugar daddy, sugar daddy, sugar daddy, sugar man, sugar man, sugar man, sugar man, sugar daddy, sugar daddy, sugar daddy. My mama was cold, and she was told she'd never been young, so she never grew old. She took a deep breath and never exhaled, lived the rest of her life from under a veil. I grew up quick, but I grew up strong. Didn't get to be her baby too long. Whenever I'd eat, I just craved sweet. What
Stay right here, I'll be coming home soon. I just emptied my lungs to some empty room. So much to say, but I just hold my tongue. The whole world's for the taking, I'ma get me some. I can do no wrong. I can do no wrong. I'm stopping now, 'cause I'm due for arrest. Been accused of the worst by some blue ribbon best. There's no mystery, no, there's nothing at all. I'm just repeating myself since I wrote Southern Drawl.